Let's talk about long-term liabilities. Specifically, we'll talk about accounting for bonds at par. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, and these borrowers are typically corporations or governments. You can think of a bond as an IOU between the lender and the borrower, and it includes details of the loan and its payments. Bonds have many features, and one of the features could be that they promise to make some interest payments before the bond matures. And so these interest payments are what are known as coupons. So back in the day, you can clip a coupon, take it to the borrower, and they'll give you cash. We can think about accounting for bonds in 3 time periods. First, the firm will issue the bond. Then, sometime later, the bond will mature. And in the interim, there might be coupon payments, so these interest payments. So at the time of maturity, we have to pay back the principal. And in the interim and also at maturity, we also have to make these coupon payments as well. So the question becomes, how much are investors willing to invest in this bond in exchange for this stream of cash flow in the future? Working backwards, at maturity, there are coupon and principal payments. In the interim, there are coupon payments. So that means at the time of the bond issuance, the firm will receive cash and create a liability because they had a bond outstanding. Let's work on an example together. Bite-Size Q&A issues a bond with the following characteristics. It was initiated on January 1st, year 1. Bite-Size Q&A opts to pay a coupon rate of 6% with coupon payments made annually at the end of the year. The principal is $10,000 and it will be repaid 3 years later on December 31st, year 3. Based on the firm/bond characteristics, the market has determined that at issuance, the market interest rate will be 6%. Let's work on a timeline first. We know that this bond starts on January 1st, year 1, and it will end on December 31st, year 3. And on December 31st, year 3, the principal is $10,000 that will be paid back to the investors. Every year, Bite-Size Q&A will pay a coupon rate of 6%, which means that it's making interest payments. These are our coupons, and those will occur on December 31st, year 1, December 31st, year 2, and December 31st, year 3. We can calculate these coupon payments as coupon rate multiplied by the face value of the bond, so that's 6% times $10,000 or $600. So we know on December 31st of every year, the coupon payment will be $600. Knowing the stream of cash flows, we can now think about what happens on January 1st, year 1. On January 1st, year 1, we got to figure out how much cash, so this is the issue price, are bondholders willing to pay Bite-Size Q&A in exchange for receiving $600 at the end of every December plus $10,000 on December 31st, year 3. That means we got to discount the stream of cash flows back to January 1st, year 1, and we'll use the time value of money concept. So we know the issue price equals to the present value of the $10,000 of principal payment plus the present value of each of the coupons. What we notice is that the coupon payments, they're identical, so $600 per year, and the intervals are identical, so it's going to be yearly, so annually. And since it occurs at the end, then we can use the present value of an ordinary annuity formula. So the issue price becomes the present value of the principal plus the present value of an ordinary annuity for the coupons. We can find the issue price of the bond by first examining the present value of the principal that's due at the end of year 3. Since it is a single amount, we know that the present value of a single amount where n equals to 3 and the interest rate is 6% would be 0.83962. So present value of the principal, which is 10,000, multiplied by the factor would be $8,396.20. Alternatively, we can use the formula and we would find the same thing. Next, we can find the present value of the coupon payments. Remember, the coupon payments is the face value of the bond, $10,000, multiplied by the coupon rate, 6%, so it's $600 per period. And since this $600 occur at the end of every single year, then we can use the present value of an ordinary annuity formula. Using the table of n equals to 3, I equals to 6%, we find that the factor is 2.67301. So multiply that by $600, we would find the present value of the coupon payments is $1,603.80. If we apply the present value of an ordinary annuity formula, we would get the same number. Then we can find the issue price as the sum of the present value of the principal, 8396.20, plus the present value of an ordinary annuity for all these coupon payments, 1,603.8, and we would find that it equals to $10,000. So now we know on January 1st, the firm will receive $10,000 from their investors in exchange for payments of $600 on December 31st of every single year, plus $10,000 on December 31st of year 3. So Bite-Size Q&A can debit cash for $10,000 to record the $10,000 that they have received from their investors. But now they have a liability outstanding, this long-term liability called bonds payable, and we'll credit that. So here is the journal entry for January 1st, year 1. Now we can move down our timeline and think about what happens on December 31st, year 1. On this date, the firm has to pay $600 to its bondholders, so they're making the coupon payment of $600. That means their cash is going to go down by $600. Then the question is, well, what's the corresponding debit side? We're going to debit interest expense, and we can calculate that as the market interest rate times the net bond liability. And what bond liability do we have? Well, all we have is the bonds payable that was initiated on January 1st, year 1 of $10,000. So the market interest rate of 6% times $10,000 is $600, and we can debit interest expense for $600. Let's also take a look at our bonds payable account. Since we didn't issue any new bonds, then our December 31st, year 1 amount for bonds payable remain at $10,000. Since ending balance becomes the beginning balance, then we know that the January 1st, year 2 balance for bonds payable is at $10,000 as well. So these are our journal entries up until December 31st, year 1. Next, we can think about what happens on December 31st, year 2. Well, on this date, we're going to make another cash payment of $600 to the bondholders. Then we got to think about what happens to the interest. We can once again calculate the interest expense as the market interest rate times the net bond liability, so that's 6% times $10,000 or $600. So we can debit interest expense for $600, and that will go with the credit of the cash of $600. For our bonds payable, the ending balance on December 31st, year 2, remains at $10,000 since there was no issuance or retirement of bonds. And that becomes the January 1st, year 3 numbers. So these are our journal entries up until December 31st, year 2. Let's think about what happens on December 31st, year 3. There are 2 payments here. First, the firm still has to make the interest payments, so this is the coupon payment of $600. Plus, here the firm will retire the bond because the bond has matured, so they got to pay back the principal of $10,000. For the coupon payment, we'll do what we did previously for December 31st, years 1 and 2, and we'll debit interest expense of $600 and credit cash for $600. For the principal of $10,000, first we'll credit cash of $10,000 to recognize the fact that the bond has matured and we're paying our bondholders $10,000 of cash. Then we'll debit bonds payable because if we don't have a bond outstanding, then we no longer have this long-term obligation. Now looking at our bonds payable, we notice that there is $10,000 of bonds payable on December 31st, year 3, before we record the maturity of the bond. When the bond matures and we pay the $10,000 of cash, we can also recognize the $10,000 of bonds payable. Hence, we have a debit of $10,000. And so after the bond has matured, our bond payable T account will reflect the value of 0. Now we no longer have a bond in real life, and we no longer have bond in our accounting books. Here we have all of the journal entries from January 1st, year 1, which is the issuance of the bond, with the interim coupon payments on December 31st, year 1 and year 2. And finally, we have the journal entry on December 31st, year 3 that recognizes the fact that there is a coupon payment plus our bond has now matured. So now you know all about accounting for bonds at par.